Hey, what's up, everybody? Welcome back to the Wealth Influencer Network, where we show, teach, and educate people on how to win at this game called money. Hey, my name is Ramon Gary, and I'm super excited to be here today just to bring you guys another free financial video. Today, we're going to be talking about the adjustment versus refund. You see, a lot of people debate about this. They kind of go back and forth. Should I be receiving a tax refund or should I not be receiving a tax refund? So I want to introduce you guys to a document that the IRS put out many years ago, and it talks about your tax refund. The name of this document is Big Refund, Big Tax Bill. So we're just going to jump right into it. We're going to skip down about halfway on this document, and I'm just going to read to you guys what it says. It says, where does your refund come from? It comes from your wallet or purse. When you tell your employer how much to withhold from your paycheck, or you make an estimated tax payment. For the average refund, that's about $40 a week too much. Now, when we look at the word refund, we know that re means again and fund means your money. So your tax refund is just your money again. Now, the IRS is stating that most people pay about $40 a week too much. Hence, you receive a tax refund. Okay? Let's continue reading. It says, you may be using the extra withholding as a forced savings method, but Uncle Sam doesn't pay interest on refunds. So what is that saying? It's saying basically you're giving the government a interest-free loan. So the government is taking money from you throughout the year. Now that money is just not sitting in some type of account. That money is being invested and making the government tens of thousands of dollars. And then at the end of the year, they don't give you any of the money off the interest they made. They just give you your portion back, the tax refund. Now, I don't know how you feel about giving the government a interest-free loan. Now, let's flip it. What if you owe the government money at the end of the year? You see, every day that you don't pay that money back, they're tacking on interest every single day. All right? Let's look at this last part. What do they say about it? It says, putting the money in any type of savings account or paying down debts may be a better option. All right, so this is straight from the IRS. It's saying you may be better off getting your money up front, saving it, or paying down some debts, or improving your own lifestyle instead of giving the government an interest-free loan. Now, anytime that you're debating and kind of going back and forth about something, we always want to let math be your teacher. All right, so we're going to go to the board here, and we're going to put some numbers up, and we're going to let math be our teacher. And see, not your opinions, not how you feel. Always let math be the answer. Okay? Now, before I put any numbers up here, I'm assuming that you have already seen some of my previous videos, and now you have took the advice, and now you are a home-based business owner. You see, when you become a home-based business owner, you open yourself up to hundreds and hundreds of tax deductions. That way you can legally lower your taxes, okay? So now, let's say you took the advice from the IRS, as it says in that document, and you went and you adjusted your W-4. Now, let's say you get $500 a month. That can be you by yourself or you and your significant other. Either way, let's say you're receiving $500 a month. Now, let's say you did that for 15 years. So $500 a month for 15 years at 8% interest. Now, you may be saying, Ramon, where in the world are you receiving 8% interest? Well, within our financial learning community, we teach you wholesale investing instead of retail investing, and that's a whole another video. But for the sake of the math, let's just go with 8%. So $500 a month times 15 years at 8% interest, you will receive $173,000. Now, that person may be saying, man, hey, I really like how my money is growing and working for me. Hey, what if I did that for 30 years? So $500 a month times 30 years at 8%. Now, if you know anything about compound interest, you know that this money, it doesn't just double, it actually grows to $745,000. Okay? Now, let's go down here to this third person. Or number three. Hey, let's look at what most of Americans are doing. It already says about 80% of the people in this country are receiving a tax refund. So this will be them right here in number three. So let's look at it. If you don't adjust your W-4, so you keep the $500 a month. $500 a month times 12 equals $6,000, right? Well, because you're receiving that back in a tax refund, guess what? It's not actually $6,000 because your tax refund is taxed, so you only bring home about $4,000. Now, let's take $4,000 times 15 years. Now, you're not receiving any interest because the government is taking that money throughout the year, so you're not having a chance to invest that money. So 4,000 times 15 years equals $60,000. Now, let's look at this. 173,000 versus 60,000. See, now you have shorted yourself $113,000. Okay? See, this is very, very profound. You see, even your tax refund is taxed. That's amazing. See, look, anything that you any money that you earn in this country is taxed. It just depends on how much. Okay? Now let's take a look at it. Let's look at it this bottom section. Let's look at it in summary. Let's look at it for over 30 years. We're going to take each one of these and let's look at it for over 30 years and we'll see how that turns out. Okay? So let's say you're getting your tax refund for 30 years. So we're still getting the same $4,000. Okay? For 30 years. And that equals $120,000. Okay? Now, you may be saying, Ramon, hey, ain't no way that they are taxing me on my tax refund. Okay. Let's give you the $6,000. Let's give you the whole thing. Even though they do tax you on your tax refund, but let's give you the whole $6,000. So $6,000 for 30 years equals $180,000. You see, either way, $120,000 or $180,000 still does not trump the adjustment of the W-4. So we have $6,000 a year. Remember, 500 times 12, $6,000 a year, times 30 years at 8% equals, again, $745,000. That is life-changing information right there. See, instead of having $120,000 or $180,000, because you became a home-based business owner, you lowered your taxes, you start investing that money, putting that money to work for you and your family, you now have $745,000 for you and your family. You see, this $745,000, because you start investing that money, it's not taxed. It now becomes tax deferred. All right. So that's the adjustment versus refund. Hey, if you like this video, please like, comment, share this video. If you like this video, please go to my website, achievecashflow.com, to receive your 4 free videos. If you like this video, you're really gonna love these other videos that we have in store for you. Again, achievecashflow.com. Enter your name and email, and we'll shoot 4 free videos right over to you. Again, so please like, comment, share this video. I want you guys to learn more about being taxed versus tax deferred. All right. Again, my name is Ramon Gary. I see each and one of you guys at the top because the bottom is way too crowded.